Are you someone who wants to take advantage of multifamily's strong cash flow appreciation and tax benefits, but you don't want to devote the time, the energy, the effort into actually running a deal full-time yourself? Well, in this video, I'm going to walk you through your options when it comes to passively investing in multifamily real estate. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it and talk about your passive investing options for multifamily. In this video, I'm going to be talking about 3 passive investing options. Well, there's actually 2 true passive investing options and then a third kind of quasi option, and I'll go into that a little bit later. But to start off, I thought it would be really helpful to highlight the differences between active investing and passive investing, just in case you're just starting to get into multifamily investing and you're not really sure which is which, but there are many differences. So we'll start over here with the active investing, and then we'll have passive investing over here. And to really emphasize this point, I'm going to use something that I call the real estate matrix. And I'll put a link up here to a video I did going more in depth into the real estate matrix. But in a nutshell, there are 4 components to every single real estate deal. We have the capital, we have the management of the deal, we have the deal itself, and then we have the financing. Without any of these 4 keys to the real estate deal, the deal doesn't happen. Every single real estate deal in history has had all 4 of these components. You take one out, you don't have it anymore. So how does this actually relate to active investing and passive investing? Well, on the active side, we need at least 3 of these components to actually make a deal happen on the active side. We need the deal itself. So as an active investor, you have to go out, you have to find the opportunity, you have to negotiate the deal, you have to beat out other buyers, you have to get it under contract, you have to underwrite the deal, make sure that there's a profit in there, you have to do the inspections, all of that sort of stuff. You have to incur the cost in both money, in capital, and time, energy, in actually hunting the deals, all of that stuff. So that goes in the active column. And then we have the financing side. You actually have to finance the deal, because if you pay for a property all cash, that's going to crush your returns. And one of the beautiful things about investing in real estate is something called leverage. And financing allows us to leverage the properties and really bump up our returns into the deal. So financing falls on the active side, because the lender is going to want to review your track record, your experience, your balance sheet, all of that sort of stuff. And then we actually have to manage the deal. And that goes on the active side. Management is very time intensive. You have to make key decisions. And I'm not just talking about, Sally in unit 506 just had a water leak, we have to fix it. I'm talking about making key decisions about what renovations to do, when to do them, how many units are we going to renovate at a time, are we rebranding the property, how are we optimizing how the property is run, optimizing the efficiencies in the property, are we going to raise rents, how much, when do we sell, offering, all that sort of stuff. That goes into full-time management. So on the active side, we definitely have the deal, we have financing, we have management, and then on the passive side, we have the capital. That is what's going on the passive side, because one thing that passive investors bring to the mix, they're not allowed to run the deal. They're not allowed to find the deal, to finance the deal, because that's an active part. All the passive investors are able to do is bring capital, bring money. So they bring their funds, and they pool their funds together, and then they invest them with an active investor. I've done videos before explaining how a partnership, a joint venture structure is not true passive investing. That actually puts a lot of the risk and the burden on the investor. And I'll put a link right up here to that video because if you're thinking about doing a joint venture and you've been told or being led to believe that that's a passive investment, you definitely should be watching that, because there are some things that you'll have to stick handle around, and then you also have to look at your risk exposure. So that's one of the, I guess, common myths out there, and I just wanted to dispel that. So definitely check out that video. So let's focus on the true ownership passive investing methods that we have. Number 1 is the syndication. And I'm trying to work on my handwriting skills here, so hopefully that's a lot more legible. And then we have a real estate fund. So we have the fund structure. So with both of these structures, there are differences, but there are similarities. To start off, remember how we had the active and the passive side of real estate investing? Well, that definitely applies within the syndication structure and the fund structure. So the difference is we have something called the GP, a general partnership, and a limited partnership. The general partnership is the active side. So they're the ones finding the deal, running the deal, financing the deal, all of that sort of stuff. The limited partnership brings capital. And the limited partnership is generally made up of multiple investors who then pool their funds together to invest in either a syndication, a specific deal, a specific project, or a fund structure. I've done more in-depth videos on syndications and funds. I'll put a link right up here to a video I did explaining all about that. For today, we're just looking at your passive investing options, not the nitty-gritty details. So generally speaking, a syndication is a specific opportunity. So a deal is syndicated on a deal-by-deal basis. So the general partner finds the deal. Sometimes the GP is called a sponsor. The terms are interchangeable. The sponsor finds the deal. They now need to raise the capital in order to take the deal down. Then they approach the limited partnership, raise the funds, and then the limited partnership invests their money with the GP, who then deploys it. And then this is the syndication model. So deal-by-deal basis. When we have a fund, the same applies. We have the fund manager here making all the decisions, running the fund. We have the limited partnership here bringing the capital into the mix. But with the fund, the investors are investing in the fund criteria. Oh, see, I wrecked my legibility already. Wrecked the fund criteria. And then the fund managers then take the capital and they'll acquire and divest of multiple properties within the fund, and the fund has a life of its own, and a fund can run for 10 years, 20 years, 30 years, 40 years, and it will grow and shrink and grow as markets change, as the fund changes, all that sort of stuff. So just keep in mind, syndication, limited partnership, single deal, single project, fund, multiple properties, and their capital is spread around those properties. What are the benefits of using either a syndication or a fund? Well, you actually get the ownership benefits of owning real estate. I mentioned in the introduction we have tax benefits. So what happens is we have something called depreciation, and we also use something called cost segregation. I'll put a link right up here to how we actually save a whole lot of money through investing in real estate. Definitely check out that video. It's really cool. And I get really excited talking about how we can save all sorts of money through real estate. So what happens is we get all these tax credits for owning this piece of real estate because according to the government, the structure is going to depreciate because it needs repairs, it gets old, it will eventually have to be replaced. Through a cost segregation study, we can actually front load a lot of those depreciation credits to create a tax write-off, a paper loss on day one, which is a huge reason why investors love investing in commercial real estate, especially multifamily, because of the tax benefits. It's not what you make, it's what you keep. And I'm pretty sure that's Robert Kiyosaki's quote. It is so very true. So what happens is we have the cost segregation study, we have all these tax credits. What happens is we have the syndication structure here, and this actually gets passed through to the general partnership and the limited partnership. So it's just like if they're owned themselves, they get the flow-through tax benefits directly to themselves, and then they're able to take that and use that to minimize their tax liability because over the life of the investment, obviously you're making money in the deal. You might be wondering, well, how does the limited partnership, how do the passive investors make money in a real estate deal, whether it's a syndication or a fund? And I'll put a link right up here to a video I did going in depth on that very topic. But for the purposes of today's video, I'll just give you a brief overview. And there are two ways. We have events that are called capital events. So a capital event is either a refinance of the property. So let's say we have improved the value of the property using the value add strategy, and I'll put a link to that video right up here. So we've increased the value through doing renovations, optimizing expenses, all that sort of stuff. And now we're able to place more debt on the property. That means a chunk of money is coming back to us, and that gets distributed depending on the split to the limited partnership and the general partnership. So that's a refinance. So that's called the capital event. And also we have the sale or divestiture, if you want to get all fancy, of the asset. So at the end of the project's life cycle, or at the end of the fund's life cycle, when the fund gets wound down, we have the sale of all the assets, and then that gets distributed to the limited partnership and the general partnership. So these are capital events. But we also have something called cash flow. What happens is these are all positive cash flow properties. So we have distributions every month. So we have, let's just put down cash flow. So every syndicator or fund is going to be different. We have some that will distribute cash flow distributions on a quarterly basis. We also have others that do on a monthly basis. So you'll be getting a check or an e-transfer, an electronic transfer of funds, depending on, it could even be annually. Every project, every sponsor is going to be different in that respect. So the way I like to describe it is you get your crumbs here during the hold period of the project. So, you know, this is like the cookie crumbs, and then that's your cash flow. And then at the end, you get your cake right here. That's a pretty bad cake, but that's where you get the big feast at the end, and that's where you get the big paycheck. So these are the two, I would call it real ownership options that you have. You get the strong cash flow, you get the appreciation, the upside of it, and then you also get the tax benefits, which are huge. But then I also mentioned at the start, there's a third option, which is like a quasi option. Well, let's get right into it. But first I got to erase this. So let's get rid of that. And I don't really talk too much about this on this channel, but I figured this would be good because if you're just getting into passive investing, if you're just learning about it, you'll come across this a lot. And so the quasi option is called a REIT, or a REIT, and it stands for Real Estate Investment Trust. And so what a real estate investment trust is basically you're owning a stock of a company that just happens to own a whole bunch of real estate. And we have three types of REITs or REITs. We have public, and these are going to be traded. We have public, non-traded. And my handwriting is falling apart as we go. And then we have private REITs as well. So with the REIT, like I said, we have a company over here that owns a bunch of real estate. And then you own a stock of the company. You own a share of the company. And these are, you know, if it's a publicly traded, you'll see these all the time, depending whether you're on the US stock market, on the Canadian stock market, you'll see REITs. But the thing is, you don't really have direct ownership of the property. You own stock. And that stock is affected by the public markets, the stock market. You're not getting the direct ownership benefits like you do get through a fund or a real estate syndication. You're more just owning stock of a company that owns properties. But the benefit of this is with the syndication with funds, there's generally investment minimums. A lot of deals you have to become an accredited investor, and I'll put a link to that video right up here explaining what an accredited investor is. With the REIT, it's just like a stock. So there are no minimums. You know, if the stock is $5, you can buy a whole bunch of stock if you choose to. You can sell it tomorrow. It's not as illiquid as a syndication or a fund. Generally speaking, there may be penalties if you pull out your money early, all that sort of stuff. And I've gone through that in past videos. So if you're looking at your passive investing options, a REIT isn't true ownership. But you will find it if you're searching online. I just thought I would touch on that. But for true ownership, to get all the benefits of real estate ownership, syndication, or a real estate fund. And if you're interested in learning more about multifamily real estate, definitely check out the Multifamily Conference, May 14th and 15th, 2022. Go to multifamilyconference.ca. Tickets are on sale right now. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.